Bubble or bust? Investment bubbles are by no means a recent trend, but the influence of social media on the herd instinct can have a crippling effect when the bubbles burst. By Susan Muldowney. In January this year, billionaire entrepreneur Elon Musk triggered an investment frenzy with a simple two-word tweet: use Signal. His note was innocent enough. Musk was telling his 42 million followers to download an encrypted messaging app called Signal. But the tweet was mistaken as an endorsement of a small medical device firm, Signal Advance. Musk's followers dutifully bought stock in the company, driving its share price up by an astounding 11,708% in just 3 days. The Signal tale is just one instance of the power of social media in uniting people from all walks of life, income levels, and geographical locations to enact change on a dramatic scale. This year's GameStop stock fiasco is another example. The Wall Street Bets forum on the Reddit website encouraged retail investors to buy the video game company's stock, causing its price to surge by 1,500% in January, and squeezing out short-selling hedge funds. GameStop's share price went from a low of $22 to a high of $624. But the bubble was quick to deflate. By the first week of February, the share price had dropped to $71. Are these examples of market manipulation, rapidly inflating investment bubbles, or perhaps a bit of both? Whatever the case, they illustrate the power of social media to rapidly shape perceptions of value among retail investors and move markets to new speculative heights. Investment bubbles are defined as the swift escalation of an asset price followed by a rapid and often devastating fall. One of the most famous, tulip mania, occurred in the 1630s when Dutch citizens rushed to buy rare tulip bulbs in hopes of reselling them for a profit. The bubble burst in 1637, wreaking havoc on the Dutch economy. Centuries later, the dot-com bubble of the late 1990s and early 2000s saw speculative fever sweep the globe. The Nasdaq Composite Index rose by 582% from January 95 to March of 2000 as investors rushed to buy shares in technology startups. By 2002, their losses were estimated at about $5 trillion. Today, social media and technology bring new elements to hysterical investment. Consider the latest craze, non-fungible tokens or NFTs, which represent ownership of unique items such as art, collectibles, or even social media posts. In March this year, for instance, Twitter CEO Jack Dorsey sold his first ever tweet as an NFT for more than $3.9 million. Dr. Timo Henkel, Research Fellow at the Centre of Applied Microeconomic Analysis in the Research School of Economics at Australian National University, describes Bitcoin as the mother of all bubbles. Bubbles don't emerge out of nowhere, he says. There is genuine basis for a bubble, but it usually involves an innovation, some kind of new product or new technology that sparks people's imagination. A story is created around it, and people project forward to it being life-changing or having a major impact. Today, that story is told and retold via social media. Dr. Brent Coker, who teaches cryptocurrency marketing at the Melbourne Business School, says much of the cryptocurrency community exists on Twitter. He says cryptocurrency traders will typically have things like TweetDeck set up to help them organize their topics. A lot of price movements in cryptocurrency are based on word of mouth, much more so than traditional stocks. There's an old saying that you never trade the news when it comes to traditional stocks, but my sense is with cryptocurrency, it's exactly the opposite. Everyone's just looking for news because it's so volatile and so random. Also, the folks that are trading crypto are not really old school Forex traders or stock exchange traders. They are mostly young, and the first thing that they may have traded is crypto, so it's all about the news. Growth in asset classes such as NFTs suggests that investors' perceptions of value are changing. The immediacy of social media also means the mass market of retail investors can be informed and influenced in real time. Simon Russell, Director of Behavioural Finance Australia, says this can play a significant role in individual stock levels. It's quite easy to join the dots between a stock going up a little bit and people thinking, well, there must be something to this, and if everyone else is buying it, it must be a good idea. Observing the sort of herd movements triggered by individuals or small groups that can encourage pump and dump schemes, he says. Russell adds that taking investment tips from the internet presents a risk of confirmation bias. We all live in our own personal filter bubbles, he says. The way that our Google searches work, for example, predisposes us to finding stuff that confirms our existing beliefs, rather than things that are going to challenge those beliefs. It's going to build confidence, and obviously the risk there is that you don't get the contrarian or the alternative views. Chris Breike, founder and CEO of digital investment advisory Stockpot, says the internet has removed geographical barriers, allowing investment bubbles to flourish. He says, even in the late 1990s, the internet allowed a lot of people to congregate together with a similar interest or focus on a particular asset class. They'd all get excited together and all get fearful together about assets, the same sort of trends that we're seeing now on Reddit. I remember being pretty identical back in 1999 on other internet forums. Obviously, the internet is now more synonymous around the world, so more people are on it, and therefore there's probably more money that can be jammed into different assets like GameStop. Perhaps that's why the dollar value of moves can be bigger. We're currently seeing a pocket of asset classes going up by an astronomical amount, and that gets people interested in markets. Investment bubbles are so called for a reason. They will eventually burst, often leaving a mess in their wake. Henkel describes a bubble's cascading effect. You get the early adopters, who are the big risk takers because they are savvy enough to think that people will latch on to this kind of technological innovation, and they clearly are trying to make a profit, he says. Then, it just trickles through the economy. Sometimes you get a couple of big adopters like Elon Musk, for instance, who convince the crowds that it's a good thing. So they start piling in as well. Think about the dot-com bubble. That's basically how it went as well. Henkel adds that the ma and pa investors tend to join in at the peak of the bubble. They're the ones who usually get burned when the bubble bursts, he says. I'm not really concerned about Bitcoin right now. Even if that crashes, it's currently too small a market to have any major ripples in the economy. But you can imagine that if there was an economy-wide frenzy to pile into cryptocurrencies and it was debt-fueled, it would become a concern, he says. Datuk Muhammad Umar Swift, CPA, CEO of Malaysian Stock Exchange Bursa Malaysia Berhad, says the increasing use of social media, online forums, and messaging applications has led to the proliferation of self-proclaimed investment advisors. While these conversations have helped maintain market interest and boosted market vibrancy, we are concerned that investors are being misguided by individuals taking advantage of chat rooms to promote their own agenda, he says. Trading manipulation or pump and dump schemes, involving the action of promoting a stock to a certain price level or deceiving investors by controlling or artificially affecting the price of a security, is not acceptable and in breach of the rules, he says. Henkel describes the recent GameStop price hike as market manipulation rather than the bubble in the traditional sense. He says, strictly speaking, market manipulation is already illegal. The rhetoric around financial markets relies very heavily on it being a level playing field, and when it's not, it compromises the credibility of financial markets and their efficiency and fairness. The thing with bubbles is, should regulators intervene and in particular take into account social media? Henkel asks. I think it would be really dangerous to give regulators some kind of leeway in adjusting policy based on what they see happening in social media. I just can't see how that works in a free market economy. According to Swift, Bursa Malaysia is already working to raise financial literacy levels among Malaysian consumers, while driving retail participation in the marketplace. He says, investor education is an important agenda for sustaining retail activity and improving the quality of activity through enhanced investor protection. Many industry analysts and academic papers have concluded that stock market participation rates would increase considerably if investors were well informed and aware of their risk appetites. The challenge is to ensure that retail investors are educated via credible sources rather than the noise of social media. Even so, Henkel suggests that social media does not create bubbles, but rather speeds up their growth. Henkel says, I don't know if social media necessarily amplifies bubbles or increases the amplitudes of price movements more generally. It just makes the information travel faster. The current cycles of Bitcoin, for example, are remarkable. I don't think that tulip mania in 17th century Amsterdam was quite that quick.